Today, we are immersing ourselves in the dynamic world of telecom and fintech, specifically focusing on a company that has strategically positioned itself right at the nexus of technology, retail distribution, and a massive growing demographic, the underserved American consumer.
Exactly. Our mission today is a really deep exploration, a surgical analysis, you could say, of the SurgePays Inc. Q3 2025 earnings call transcript, that's SURG. We've dissected the prepared remarks from CEO Brian Cox and CFO Tony Evers, plus the highly insightful and I'd argue crucial Q&A session that followed.
Right.
This isn't just a quarterly check-in. Management is explicitly framing Q3 2025 as a major inflection point. They're signaling a definitive shift from, investing and building infrastructure to aggressive margin-focused scaling.
So we're going to be extracting the essential knowledge, those nuggets of insight that explain the massive financial acceleration we're seeing, the strategic competitive moats they are building, and exactly how they plan to achieve their pretty ambitious 2026 guidance using this unique 5-channel synergistic strategy. If you are tracking the economics of value-focused services targeting the subprime market, well, this deep dive is mandatory.
Yeah, we're here to synthesize that complex interplay between, government subsidies, high-margin wholesale telecom, and these data monetization engines they're building.
Okay.
We want you to walk away understanding not just what their numbers were, but why their strategic execution in Q3 really validates their multi-year investment thesis, especially when you look at that massive Corpay partnership and the resilience of their retail network.
We truly appreciate you joining us for this analysis. Before we jump into the raw data, if you find this type of detailed, objective breakdown helpful, if we are saving you hours of research, please do us a favor, right?
Please do.
Click that like button. Share this deep dive with a colleague who needs a concise summary of the subprime financial or telecom landscape. And definitely subscribe to make sure you stay tuned for more of our in-depth content.
We live for these deep dives, and your support really does keep us going.
Okay. Let's open the books.
So, as usual, the call kicked off with the standard forward-looking statement disclaimers. Standard stuff.
Right, the legal necessities.
But CEO Brian Cox, he quickly cut to the chase.
Yeah.
He set a very distinct, almost confident tone right from the start.
Yeah, I noticed that. He immediately declared that Q3 2025 was, and I'm quoting here, less about the past and more about what's ahead.
And that phrase, that's a strategic communications choice, right?
Yeah.
It's signaling to the market that the narrative is fundamentally shifted.
How so?
Well, those years spent in heavy capital expenditure, building out the infrastructure, which really started back around 2022, they're saying that's done. Now it's yielding strong, measurable results. And we see this validation in the sequential growth, that's quarter over quarter, which often gives you a clearer picture of operational momentum than just looking year over year.
Right, it shows the immediate trend.
Exactly. The message is the platform is built, it's established, and now they're ready to monetize it and monetize it rapidly.
And the mechanism for this future growth is what they kept calling the synergistic ecosystem. It's not just one product carrying the load.
No, it's this closed loop of 5 distinct reinforcing revenue channels. And we really need to drill into how these 5 channels work together because this is what they're betting on as their competitive moat.
Okay, lay them out for us.
Right, the synergy is key. So the 5 channels are first, Torch Wireless. That's their government-subsidized wireless service, mainly through the FCC's Lifeline program. Think of it as the initial customer hook.
Got it, Lifeline.
Second, LinkUp Mobile. This is their own affordable, value-focused, prepaid mobile offering. It's for non-subsidized users, or maybe those who graduate from Lifeline.
Okay, prepaid.
Third, Hero MVNE.
Oh.
That stands for Mobile Virtual Network Enabler. Right. This is their high-margin, low-overhead wholesale arm. It lets other MVNOs use SurgePays direct carrier access. Big deal.
Wholesale, high margin.
Fourth, simple prepaid top-up services. Just basic high-volume transactions for topping up phone services across various carriers. Bread and butter stuff.
Okay.
And fifth, Clearline SaaS Point of Sale, or POS. This is their proprietary tech platform. It ties all the digital engagement and the financial transactions together right there at the retail level.
Okay, so 5 channels, all reinforcing each other. But the core seems to be that distribution mechanism you mentioned.
Exactly. They are pairing this cutting-edge tech, the Clearline POS platform, with a massive nationwide retail distribution network. And crucially, they're focusing almost exclusively on locations embedded in underserved communities.
So not the big chain stores necessarily.
No, think about the flow. They're capturing the consumer at the point of necessity, the local convenience store, the corner market, that kind of place. By integrating their Clearline POS, they turn the store owner from just a passive vendor into an active partner, someone who profits from promoting SurgePays services.
Oh, all right.
And because they're focused on the underserved community, the services they offer, Lifeline, affordable prepaid financial tools, these are inherently high demand, especially during times of economic doubt or uncertainty.
Makes sense.
So this combination of proprietary tech and this really entrenched physical footprint, that's tough for rivals to replicate quickly. That's the moat. Hashtag key financial results.
Now, let's transition into the numbers that supposedly demonstrate this infrastructure is working. When we look at the top line, the revenue surge is, well, it's pretty staggering.
Absolutely. Q3 2025 total revenue hit $18.7 million. But it's the comparison metrics that really signal the acceleration.
Okay.
That's an increase of 292% year over year compared to Q3 2024, almost 300%.
Wow.
And maybe even more importantly, it represents over 62% sequential growth, quarter over quarter.
62% sequentially.
Yeah. This massive sequential acceleration confirms that the scaling phase is fully underway. They're leveraging that platform they spent the last 2 years building.
Okay, let's break down the two main revenue engines driving this. Starting with the Lifeline segment, right? That's Torch Wireless.
Right. This segment's revenue jumped from almost nothing, practically zero in Q3 2024, to a really robust $5.6 million in Q3 2025.
Huge jump.
Yeah. This rapid deployment of the Lifeline subsidized program gives them immediate, stable recurring revenue. And management was very, very keen to stress this point.
Which was?
That this is a fully funded government benefit. And crucially, it is unaffected by any current or potential government shutdown scenarios.
That's a big deal for predictability.
Huge. It makes it a highly reliable revenue base in what can be an uncertain environment.
And the subscriber growth reflects this too, right? They mentioned number.
Oh, yeah. They started scaling seriously back in June with about 20,000 subscribers. Now they're reporting over 125,000 subscribers.
From 20K to 125K in just a few months.
It's like a 500% plus increase. But here's the interesting strategic bit. Management said they are operating well below their capacity.
Meaning they can handle more.
Way more. And they're excited about, quote, new, lower-cost customer acquisition methods.
Okay, lower cost acquisition. Why is that so significant?
Well, this is where it gets strategically interesting. Historically, acquiring subscribers in this space, the Lifeline space, involves really heavy upfront marketing costs. It creates what they call a front-heavy ROI model. You spend a lot upfront to get the customer.
Right, makes sense.
But if SurgePays can actually execute on this belief they shared, that they're finding new avenues for acquiring customers with little or no cost, which, by the way, they hint at later in the Q&A through their retail partner incentives.
I'll get to that.
Right. If they can do that, they are fundamentally reshaping the unit economics of the entire Lifeline sector. Think about it. If the cost of customer acquisition, the CAC, drops significantly, while the lifetime value, LTV, stays high and stable because of that recurring government subsidy.
Then profitability just accelerates dramatically.
Exactly. That's the potential game changer there.
Okay, so Lifeline is a short-term revenue accelerator. But the other half of the business, the point of sale and prepaid services, that's validating the non-subsidized consumer demand, right?
Precisely. That segment, which includes LinkUp Mobile and those prepackaged smartphone kits they often call phone in a box.
Right, the grab-and-go kits.
That segment brought in $13.1 million in revenue this quarter. That itself represents a 177% increase year over year.
Still huge growth.
Absolutely. And the LinkUp Mobile growth story within that is maybe the most compelling validation of their retail distribution network. They launched LinkUp back in April with only 10,000 users.
Okay.
They doubled activations by July to over 20,500. And now they report over 95,000 recurring active subscribers on LinkUp Mobile.
95,000 active, paying, non-subsidized subscribers in less than 6 months.
Yep. That proves the model works outside of government grants. It shows the underserved community is willing to buy value-focused products through these convenience store channels. #tag strategic initiatives and monetization engines.
Okay, moving beyond the financials now, let's look at how they plan to sustain and accelerate this growth. The first initiative seems straightforward, just distribution scale.
Right. Their near-term target is aggressive. 100,000 retail locations operating on the SurgePays platform.
100,000, how do they get there?
Well, it's a mix. They're achieving this through their own internal organic growth, signing up stores one by one or in small groups, but also through critical distribution agreements. They specifically called out partners like HT Hackney.
HT Hackney, that's a big name in distribution, right?
Massive. HT Hackney provides access to literally tens of thousands of convenience stores nationwide. Leveraging established distributors like Hackney drastically cuts down their own distribution costs and, crucially, their time to market.
So it's a force multiplier for getting that Clearline POS system deployed.
Exactly. It's much faster than doing it all themselves.
Okay, next up is the Hero MVNE platform, their wholesale high-margin engine. You said this is a technical competitive moat. Explain that a bit more.
Yeah, this is where their technical setup gives them an edge. See, most MVN mobile virtual network operators in the market are actually sub-MVNOs.
Sub-MVNO.
Yeah, meaning they buy bulk minutes and data, not directly from the big carriers like AT&T or T-Mobile, but from another MVNO. This limits their control, their flexibility, and definitely their margins.
Ah, okay. There's an extra layer in there.
Right. SurgePays, through their Hero platform, is one of the few with direct carrier access. They're buying capacity straight from the Tier 1 carriers themselves.
So why does that matter so much? What's the benefit?
Well, two main things. First, it grants them superior margin potential because they cut out that middleman MVNO layer. More profit per customer.
Makes sense.
Second, gives them strategic flexibility. They can design truly tailored plans for their own customers, like Link Up Mobile, or for their wholesale MVNE partners. They have more control over the product.
Okay, so it's a high-margin model, and you said minimal incremental costs.
Pretty much. Once the platform is built, adding more wholesale partners doesn't cost them nearly as much as adding retail subscribers.
Yeah.
They've already onboarded 3 MVNO partners who serve thousands of subscribers combined.
Right.
And they mentioned that following the recent all-wireless and prepaid expo, they anticipate integrating significantly more wholesale clients over the next 6 months.
So that wholesale revenue stream could grow quickly.
And it's clean, high-margin revenue, highly scalable without needing a corresponding gross in their physical store footprint, a very attractive part of the business model.
Okay, the second major strategic initiative you mentioned involves their SaaS platform, Clearline, and this newly announced partnership with Corpay. This sounds like the fintech layer binding it all together.
That's exactly right.
Yeah.
Clearline is the true technical engine here. It's not just a payment terminal. It's an interactive POS system. It manages customer engagement, loyalty programs, coupons, real-time marketing offers right there at the counter. And the strategic partnership with Corpay, which is a major player in cloud-native payment processing, that's potentially a game changer for Clearline's reach.
How so? What does the partnership do?
Instead of Clearline being just a standalone marketing tool that a store owner might use alongside their existing payment system, they are embedding Clearline's features directly into Corpay's payment solution.
Ah, so it's integrated, not separate.
Integrated. This fusion creates a marketing automation layer built right on top of the payment transaction itself. Imagine swiping a card and instantly getting a relevant offer or a loyalty point update through the same system.
Okay, I see. That sounds sticky.
That's the essence of sticky recurring revenue. They're moving beyond simple payment processing into value-added services. For the retailer, it's potentially a better payment solution with built-in digital marketing tools, probably at a competitive price.
And for SurgePays and Corpay?
It creates new, sticky revenue streams that are harder for competitors to dislodge. Once a retailer adopts this integrated system, switching away becomes more difficult. And management sees Clearline's potential far beyond the current, 17 market basket convenience stores they mentioned?
Yeah, a small pilot group.
They see this tech being applicable to hundreds of thousands of retailers eventually. Think tire shops, local restaurants, food trucks, salons, basically anywhere they can embed their digital marketing sauce tools into a payment process through that Corpay partnership. Hashtag tech financial health and guidance.
Okay, the CEO's strategic vision is certainly clear. Execution, scale, high-margin growth. But that leads us directly to the CFO, Tony Ibbers. He provided the, let's say, reality check on the financial health needed to actually sustain this trajectory.
Right. The company is not profitable yet. That's important to state up front. But the path to leverage, the path to profitability, is becoming much more sharply defined based on these Q3 results.
Okay, how so?
Well, let's look at the gross profit line first. The gross profit loss narrowed significantly. It was down to $2.6 million in Q3 2025.
Okay, $2.6 million loss. How does that compare?
That's a massive improvement from the $7.8 million gross profit loss they reported back in Q3 2024. So they're successfully leveraging their scale and that direct carrier access we talked about. The margins are improving.
And what about going forward? Any guidance on that?
Yes, and this is critical. They noted that most of the heavy lifting and the launch costs associated with Clearline are now complete. So they project that the POS and prepaid segment gross margin will actually be positive by the end of 2025.
Positive gross margin by year end.
That's the projection.
Yeah.
That would be a crucial milestone, proving the underlying profitability of their largest revenue segment.
Okay, improved margins. What about spending? Are they controlling costs while growing so fast?
Actually, yes, and this is impressive. SG&A, that's selling, general, and administrative expenses, decreased by 32.5% year over year. It dropped to $4.2 million.
Down 32%. How did they manage that with revenue exploding?
Primarily, they said, by right-sizing their organizational structure, specifically reducing contractor and consultant expenses, which can ramp up during build-out phases.
Let's just pause on that for a second. A company grows revenue by nearly 300% and cuts operating expenses by over 30%. I mean, that is the textbook definition of operational leverage starting to kick in, isn't it?
It absolutely is. It strongly suggests their infrastructure, their platform can handle massive revenue growth without needing corresponding increases in overhead. That's exactly what investors want to see in a scaling tech company.
Okay, so what's the bottom line impact?
The net result is that the loss from operations improves substantially. It narrowed to $7 million in Q3 2025. That's down from $14.3 million in Q3 2024, so basically halved the operating loss year over year.
Still a loss, but much smaller relative to revenue.
Right. The final net loss was $7.5 million, or negative 0.38 cents per share. Again, the losses are shrinking rapidly relative to that accelerating revenue base.
Okay, but wait a minute. If we look at the balance sheet, there's maybe a point of tension here. Cash equivalents, and investment balances. As of September 30, 2025, were $2.5 million.
$2.5 million?
That's down sharply from $11.8 million at the end of last year, 2024. Now, that decrease reflects the investment phase they were just completing, sure, but $2.5 million? That sounds like a very thin runway for a company projecting such aggressive growth, and one that still has quarterly losses of $7.5 million. Doesn't that financial risk undercut the confidence they're projecting?
That is the critical challenge, absolutely, when you're analyzing these high-growth companies. Management is essentially walking a tightrope.
Seems like it.
But their confidence seems to stem from two main factors. First, the predictability of that lifeline revenue stream. Remember, it's stable, recurring, government-backed.
Okay, stability there.
Second, their explicit expectation, which we just discussed, of the gross margin flipping positive in the POS segment by year-end.
Right.
They execute on those margin improvements as projected. The cash burn should slow dramatically or maybe even reverse entirely as they head into 2026.
So they're betting on execution, improving the cash flow quickly.
Exactly. And the fact that they strongly reaffirmed their ambitious $225 million revenue guidance for fiscal year 2026 suggests they are confident the cash generated internally through improved operational efficiency will be sufficient to fuel the scaling phase without needing immediate, say, further dilution from selling stock.
Okay, so it's high risk, high reward, really betting on hitting those operational targets.
Precisely. It all hinges on continued execution, especially on the margin front.
Okay, so before wrapping up the prepared remarks section of the call, CEO Brian Cox came back to talk about what he sees as the long-term, potentially highest margin competitive advantage. That was the launch of this new division, growth marketing and data partnerships called Digitize IQ.
Yeah, this is a fascinating pivot, or maybe evolution is a better word. Digitize IQ was created by fundamentally re-engineering their legacy Logix IQ system.
Logix IQ. Wasn't that something completely different?
It was. We should note, Logix IQ was originally used for lead generation, primarily for mass tort law firms. It was a business they completely shut down over a year ago to get laser-focused on the telecom and fintech opportunity.
Right, I remember that.
But the underlying technology, the capability they built with Logix IQ, was all about building highly scalable, compliant intake funnels. Basically, systems for capturing and verifying large volumes of consumer information efficiently and legally.
Okay, so they didn't just scrap the tech, they repurposed it.
Exactly, they retooled it. The new Digitize IQ is now transformed into a powerful automated intake and marketing engine designed explicitly for the underserved subprime consumer market, for marketing and data collection within that specific demographic.
So they're leveraging that core competency they already had in scalable intake and compliance.
Precisely. Now, instead of generating leads for lawyers, they're operating a platform that connects affiliates and publishers, people who can drive traffic to generate verified consumer information.
What kind of information?
Things like demographic data, behavioral data, information that's essential for marketing their own products, like LinkUp Mobile or future financial services, but also potentially for external data licensing down the road.
So it turns customer acquisition almost into a data asset generation process.
Right. This capability essentially transforms verified consumer necessity people needing affordable services into scalable, high-margin data assets.
And here is the really essential context for this entire market strategy, which management makes sure to note, based on external research.
Yeah, this number is critical. The subprime market, the group they're targeting, has ballooned dramatically. It's grown from roughly 100 million people to over 137 million people in just the past 4 years.
137 million people. That's a
Yeah.
huge segment of the U.S. population.
Masses, and that statistic is the primary tailwind for SurgePays. It means their target demographic isn't just large, it's actively growing,
Yeah.
largely due to shifting macroeconomic conditions, inflation, things like that. So they view the market intelligence they can derive from serving this 137 million person segment, the transactional data, the behavioral data, purchasing patterns. They see that data as a powerful, long-term competitive advantage that strengthens every part of their MVNO and fintech operations.
Okay, so wrapping up the prepared remarks then. Q3 seems to be the quarter that confirmed the heavy investment phase is over. The platform works, growth is clearly accelerating, and the strategic focus has now pivoted toward aggressively leveraging the margin potential, both from the MBNE wholesale model and from the data gathered from this massive, growing subprime consumer base.
Yeah, it's a very integrated strategy. Ambitious, certainly, maybe even aggressive, but it's a cohesive narrative they presented.
Okay, so with the prepared presentation complete, the floor opened for questions from analysts. It seems like there was only one analyst who asked questions this time.
That's right, just one analyst, Ed Wu, from Ascendiant Capital.
Yeah.
But his questions were highly targeted. They really probed the company's resilience, the market perception of their products, and the overall sustainability of the model.
Okay, so Ed Wu, Ascendiant Capital, let's start with his first question. What was he trying to get at?
Analyst query summary. Basically, Ed Wu asked for feedback from the front line. He wanted to know specifically, what are the store owners saying about these new SurgePays products? And maybe more importantly, how receptive is that target subprime customer to actually adopting them? Is it working in the real world?
Right, that's a crucial test of execution. Does a product actually resonate with both the merchant and the end user? It sounds good on paper, but...
Exactly. And Brian Cox, the CEO, immediately tied the positive reception they're apparently seeing to the current economic environment. He provided what he called tough time feedback.
Tough time feedback, meaning...
Meaning, he explained that when people are facing economic doubt and uncertainty, as he put it, they are psychologically more open to finding better value alternatives. They're more willing to step out of their rut in the road, their usual habits, and try something new if it saves them money.
Okay, that makes psychological sense. And it ties directly back to that macro data point you mentioned earlier.
Precisely. The rapid growth of the subprime market to 137, 138 million people. That difficult economic reality for millions is, frankly, beneficial for a company offering value-based alternatives.
Right.
But the CEO's response was, I thought, quite masterful. Because he didn't just focus on the end consumer. He spent significant time detailing the economic benefit for the store owner, who is technically SurgePays' immediate client.
The store owner's also a client here looking for extra income.
Exactly. Store owners are also clients seeking supplemental income, maybe just a few hundred extra dollars per month. And this is really the heart of their win-win-win strategy they seem to be building.
Okay, let's break down the mechanics of how the store owner actually profits. Because this sounds like it relates to that low-cost customer acquisition strategy we talked about earlier.
It absolutely does. First off, the POS platform itself, the Clearline system, it's completely free for the store owner to install and launch.
Zero upfront cost for the retailer. That's a big barrier removed.
Huge. Zero capital investment required. Second, the commission structure is specifically built to incentivize active promotion by the store owner.
How so?
Store owners receive significant commissions. That word significant was used on prepaid wireless activations for any carrier that are processed through the Clearline terminal, not just SurgePays' own LinkUp Mobile.
Oh, okay. So even if a customer tops up Verizon or AT&T prepaid, the store owner gets a cut via SurgePays terminal.
That's the implication. This drives foot traffic because customers know they can manage all their prepaid services there, regardless of the brand. It makes the store a destination.
Okay, that's clever. But you mentioned something about SNAP EBT cards being a key lever.
Yes, this is probably the deepest integration point, and it acts as an incredibly powerful customer acquisition lever for their Lifeline program.
Okay, explain that. For those unfamiliar, SNAP EBT cards are the electronic benefit transfer systems used for government food assistance, right?
Correct. That's how people receive and spend food stamp benefits. So here's the financial flow SurgePays has engineered. When a customer comes into the store and uses their SNAP EBT card to buy groceries,
Yep.
SurgePays has integrated the ability for the store owner, right then and there at the counter, to offer that same customer-free wireless service, which is the Torch Wireless Lifeline program.
Offer free service based on their EBT status.
Essentially, yes, leveraging the likely eligibility. But here's the critical point for the store owner. The store owner gets paid a commission by SurgePays for facilitating that free service enrollment.
Wow, so the store owner gets paid to sign someone up for a free service.
Exactly. And SurgePays, in turn, gets paid by the government for activating a new Lifeline subscriber.
Okay, that sounds like, well, a genius system, frankly.
It really is quite clever.
Yeah.
The store owner sees guaranteed increased foot traffic because they offer this valuable service, and they earn commission simply by leveraging existing government programs. The consumer gets a free service they desperately need, providing immediate savings. And SurgePays acquires a stable, recurring revenue Lifeline subscriber at what is likely a very, very low acquisition cost compared to traditional marketing.
It basically makes the store owner the most enthusiastic marketing arm the company could possibly have.
Precisely. That detailed mechanism explains exactly why management is so confident about finding those new avenues for acquiring customers with little or no cost. They've effectively weaponized the need for value in the subprime community and the store owner's desire for supplemental revenue, creating that powerful synergistic loop right at the point of sale.
Okay, that first Q&A point was really illuminating on the ground level mechanics. What about the second question from Ed Wu? What did he ask?
His second question addressed a macro concern, something highly relevant to the retail space they operate in. The impact of ongoing consolidation among major convenience store brands.
Ah, right. You see that all the time, big chains buying up smaller ones.
Analyst query summary. So Wu asked how this seemingly relentless consolidation in the convenience store sector, where smaller chains are bought up by the giants like 7-Eleven or Circle K, might that impact SurgePays' highly decentralized business model, which really relies on those local relationships with individual store owners?
Yeah, that's a great question. It challenges the resilience of their competitive moat, doesn't it? If these big corporate entities come in and impose strict vendor guidelines from the top down, wouldn't SurgePays' local relationships just get wiped out?
That's exactly the risk he was probing. And the CEO's response was, again, a fascinating deep dive, this time into the almost archaic, you could say, structure of the convenience store supply chain.
Okay.
He defended the company's position, first, by highlighting the historical nature of the distributors they partner with, mentioning names like H.T. Hackney again, Long, McLean.
Right, the ones you mentioned earlier.
He pointed out these are often century-old second- and third-generation family companies. They have deep local roots, and they tend to act as a buffer against rapid top-down corporate change imposed by the big retail brands. The distributors have their own power.
Interesting point. But what about the stores themselves? Surely 7-Eleven corporate tells its franchisees what they can and can't sell.
Well, this is where the CEO stressed the surprising degree of autonomy that's maintained at the individual store level, even under major corporate branding.
Really? Even in a big chain?
Apparently so. He explained that even when a major corporation like 7-Eleven acquires a brand or has franchisees, the person actually running the store, who is often the local owner or a long-term clerk managing the place, they still retain significant control over certain aspects.
Like what?
Specifically, control over a portion of the store floor and the services offered. They often have the autonomy to bring in their own products or decide on value-added services beyond what corporate mandates, especially if it drives traffic or profit for their specific store. And he added, 9 times out of 10, the ultimate decision maker at that store level, the person SurgePays needs to convince, is the person working the counter, the clerk or the local manager owner.
So SurgePays' strategy is essentially to bypass the corporate headquarters bureaucracy.
Completely.
Yeah.
And build an active financial relationship directly with that specific individual store runner. The person who benefits directly from the commissions SurgePays offers and the increased foot traffic driven by the Clearline platform.
They're betting on the local P&L winning out over corporate directives sometimes.
It seems so. Furthermore, they emphasized the depth of their technical integration as another insulator against corporate restructuring or vendor mandates. The CEO stated this quite emphatically. He said, "We are in the checking account. It is not just something where people are signing a PO and sending us a check."
In the checking account, what does that imply?
It implies SurgePays platforms, particularly Clearline with its payment processing and commission tracking, are integrated so deeply into the retailer's daily financial operations.
Right into the money flow.
Exactly. Processing payments, managing commissions, tracking sales, it's core to how the store operates financially day to day. Removing them wouldn't be like just taking a product off the shelf. It would create significant operational friction and financial disruption for that local store owner or manager.
Making it much stickier than a simple vendor relationship.
That's the argument. So the company's position is that while consolidation might happen at the corporate level, the combination of direct financial incentives for the local operator and the deep operational integration at the store level means their competitive footprint is actually quite robust and resilient against simple top-down corporate vendor changes.
It speaks volumes about the potential stickiness of that Clearline platform if they can get it widely adopted.
Exactly. The moat, as they see it, isn't built on exclusive contracts with corporate giants that can change overnight. It's built on potentially hundreds of thousands of individual, hopefully profitable, relationships with local entrepreneurs running those stores.
Okay, that was an incredibly dense transcript, really filled with strategic context and some pretty aggressive financial targets. Stepping back, what are the main narratives? What are the key implications we should walk away with after this deep dive?
Yeah, absolutely. I think we can synthesize the core themes into probably 4 highly actionable insights for you, the listener, confirming where this company really stands at the end of Q3 2025.
All right, let's hear them. Let's start with that central narrative you mentioned, acceleration and scale.
Right. Theme 1. Q3 has definitively marked the end of the heavy investment phase and the clear initiation of the scaling phase. The evidence is just overwhelming.
How so?
It's that combination of the 292% year-over-year revenue surge and, maybe more tellingly, that 62% sequential growth we keep coming back to.
Right.
The infrastructure is deployed, it's working, and we're seeing network effects across those 5 synergistic channels, from the rapid subscriber growth in Lifeline Torch to the clear validation of consumer demand in the prepaid link-up mobile.
And the wholesale piece.
And crucially, that high-margin Hero MVNE wholesale model is ramping up. That's absolutely critical for their future profitability leverage. So point 1 is just sheer acceleration and scaling are happening now.
Okay, takeaway number 1. Acceleration and scale are real. What's number 2?
Number 2, the core of their entire strategy is inextricably linked to this rising subprime focus.
Focusing on that 137 million number.
Exactly. Their growth is being fueled by a profound and, frankly, unfortunate macroeconomic trend. The fact that the subprime or underserved consumer base has grown so dramatically.
Right.
SurgePays is capitalizing on the necessity created by this trend by providing efficient, lower-cost communication and increasingly financial infrastructure tailored to this group.
Okay.
This focus provides them with 1, stable recurring telecom revenue streams like Lifeline and LinkUp, but 2, and perhaps more importantly long-term, it provides the raw data required for that scalable, high-margin data monetization engine, Digitize IQ.
So they're positioned to leverage the economic necessity of this massive demographic.
For sustained business growth, yes. They've successfully positioned themselves right in the middle of that dynamic.
Okay, theme 2 is the subprime focus and data engine. What's number 3?
Number 3 relates to the Q&A discussion.
Sure.
The resilience and importance of their retail moat.
The convenience store network.
Yes. Their competitive advantage, today at least, is heavily built on that physical distribution network, and their apparent success in converting those individual store owners into active, incentivized partners.
Through those free platforms and commissions.
Exactly. The structure free-to-launch POS, significant commissions, and that highly effective SNAB EBT to Lifeline acquisition mechanism, it ensures the store owner is financially invested in promoting SurgePays offerings.
And the consolidation risk.
Well, as the Q&A seemed to confirm, their focus on local autonomy and that deep financial integration being in the checking account provides a structural defense, or at least mitigation, against the risks of top-down corporate consolidation in the convenience store space. So the retail network itself is a key part of their moat.
Okay, retail moat is number 3. And finally, number 4, the financials.
Number 4 is the financial trajectory. which, despite that low cash balance causing some near-term concern, suggests that leverage is kicking in.
How do we see that trajectory?
The trajectory itself is highly positive, right? Transitioning from heavy losses to much narrower losses.
Hmm.
You see it in the narrowing of the gross profit loss from $7.8 million down to $2.6 million year over year. Combine that with the simultaneous 32.5% reduction in SG&A operating expenses. That demonstrates significant operating leverage. The model is becoming more efficient as it scales.
And the key milestone is that positive gross margin projection.
That's the linchpin for the near future. The expectation for the Clearline POS segment to achieve positive gross margins by the end of 2025 is absolutely key to unlocking the cash flow needed to meet that bold, reaffirmed $225 million revenue target for fiscal year 2026.
So the financial risk we discussed is real, but management is clearly betting hard on margin expansion, accelerating rapidly enough to self-fund the next phase of scaling.
That's the bet they're making, yes.
Okay, that's a great summary of the key takeaways. But it does bring us to this powerful, maybe lightly uncomfortable, lingering question raised by this entire transcript. We know their growth engine is fueled by necessity, right? The economic pressures facing those 137 million Americans who desperately need value-driven financial and communication services.
Right. And it raises an important, maybe long-term ethical or strategic question about the dual nature of this business model. On one hand, SurgePays is acting as an extremely efficient, arguably necessary, value provider to a financially vulnerable population. They're filling a real need.
Absolutely, providing essential services at lower cost.
However, by simultaneously building out Digitize IQ, they are also positioning themselves as a scalable, high-margin engine explicitly designed to monetize the transactional and behavioral data derived from this demographic's economic challenges.
So is their ultimate success defined by their superior ability to provide essential value? Or is it defined by their unique positioning to harvest and monetize the data streams generated by a population whose economic situation is, in many cases, deteriorating?
Exactly. That tension, the simultaneous role as social value provider and potentially powerful data harvester targeting economic necessity that feels like the fundamental long-term narrative. It will likely determine both the durability of their competitive moat and their eventual valuation trajectory in the market.
That's definitely the thought for you, our listener, to carry forward from this deep dive. Something to mull over.
The necessary infrastructure is built. The scale is clearly accelerating. Now the world watches to see how they manage the harvest, so to speak. #HowPays outro.
And that wraps up our extensive deep dive into the SurgePays Q3 2025 earnings transcript. We really trust you now have a comprehensive strategic understanding of this company's inflection point, its potential competitive moats, and the massive market tailwind that's driving its aggressive growth strategy.
Yeah, hopefully we've translated hours of pretty dense financial and strategic source material into concise, actionable insights for you, saving you valuable time. You should now be equipped with the critical context needed to evaluate their next moves and understand the narrative going forward.
Absolutely. If you found this detailed breakdown valuable, if we helped cut through the noise, please take just a moment to click the like button right now. It really helps us out.
It does.
Share this deep dive with someone else you know who needs this shortcut to specialized knowledge in the fintech or telecom space. And please subscribe so you never miss our next analysis into compelling source material.
Thank you so much for joining us for this deep dive.
We appreciate your time. We'll see you next time.